Morning. My name is Anurag Tiwari. Today, I'm going to present Pricing of MFI Loans. Microfinance institutions or MFIs provide small loans to low-income individuals who generally do not have access to traditional banking services. These borrowers are usually from rural or semi-urban areas and may not have collateral or formal income source. Unlike commercial banks, MFI operate using a high-touch, face-to-face service model. Field officer visits villages, conduct group meeting, disburse loan at the doorstep, and collect repayment regularly. Now, loan pricing refers to how MFI decides the interest rates and charges on these loans. The purpose of pricing is not just to earn profit, but to balance the critical aspects, client access to credit, institutional sustainability. Since MFI operates with intensive field operations rather than mass market banking like commercial banks, their costs are naturally higher. Many people believe MFI interest rates are high. However, use these rates reflect the actual cost of delivering financial services to financially excluded population. In this slide, we understand why MFI interest rates are higher compared to commercial banks. There are four main reasons. Let's talk about the first reason is high operating costs. MFI incurs significant expenses such as field staff salaries, transportation to remote villages, cash handling, and branch overhead costs. Since they serve scattered rural customers, logistic expenses are high. Second, small ticket size. MFIs provide loans of rupees 10,000 to rupees 50,000. However, the administrative work required to process a small loan is almost the same as large loan. In a commercial bank, this increases the cost per rupee lent. Third, door-step delivery. MFI disperse and collect loans at borrowers' home or villages centers. Unlike banks where customers visit branches, MFIs go to customer. This includes staff time and travel cost. Fourth, intensive monitoring. MFIs conduct weekly meetings, regular follow-ups, and borrower monitoring to ensure repayment discipline. While this reduces default risk, it increases recurring operational expenses. When we combine all these cost drivers, we understand why MFI charge a higher interest rate than traditional banks. The objective is to access profit, but to sustain outreach while managing risk. This slide explains the components that make up MFI loan pricing. Loan pricing consists of four elements. This is the cost of fund. MFI borrows money from banks or financial institutions at a certain interest rate. For example, if they borrow at 10%, they must charge more than 10% to cover additional cost. Second is operation cost. This includes staff salaries, travel, administrative expenses, IT system, and branch maintenance. In microfinance, operational cost is a significant part of pricing. Third is risk premium. Since MFI loans are unsecured and given without collateral, there is a possibility of default. A small percentage of interest is added to cover expected credit losses. Fourth one is fees. These include processing and documentation charges. These are usually one-time charges to cover administrative expenses. Together, interest and fees cover cost of funds, operational cost, risk premium, and processing charges. This slide also highlights the importance of transparency. Clear disclosure of all components build client trust and support fair regulation. In addition, I would like to conclude that subsidies or blended finance model can help reduce borrower interest rates without affecting institutional sustainability. So, proper pricing ensures both financial viability for MFIs and reliable access to credit for vulnerable clients. Policy note: transparent disclosure of all components fosters client trust, and enables for fair regulation. Thank you.